Today's cardinal lesson is about required minimum distributions, or what they're called and abbreviated as RMDs. And so anybody that has an IRA or a traditional IRA is subject to required minimum distributions. And they start at age 72 now under the Secure Act. That changed, and so every year after you attain 72, you're required by the government and by the IRS to take a certain minimum amount out of your IRA, and then you've got to pay the corresponding income taxes. And so the reason we're talking about this is if that's all you're taking out of your IRA, or that's all you're planning to take if you're not 72 yet, but you're approaching retirement or in retirement and you have an IRA and you're just waiting till the government requires you to take some money out, you're really on the government's plan for distribution. I mean, you're just going to take what they make you take, which is a signal to me that you don't have a plan for distribution. So what I'm going to do in my practice a lot is I'm going to remove the R and the M and just talk about distributions. Is taking money. That's what your IRA is for. People used to have pensions, and now they have 401ks and IRAs with a balance in there. Well, what is that balance there for? It's not necessarily there to be a savings account. It's to produce an income. It's for you to live off of in retirement. And the government is just saying, by the time you reach 72, you're retired, you got to take a certain amount. Okay? So what do RMDs do for you? I mean, or distributions in general, is they're going to increase your tax bill. So if you have to pull $20,000 out of your IRA, that is going to be added to your other income and you're going to have to pay taxes. And so that's not news to most people. That's money coming out of there is taxable, that's fine. But that's also going to increase the income taxes you pay on your Social Security check, and it's going to increase possibly the amount of tax or premium you pay for Part B and D of Medicare, or what's referred to as IRMA, Income Related Monthly Adjustment Amount. So we could get off on a bunch of tangents here, but generally speaking, if you have to pull money out of your IRA, you do pull it out. It's not only going to create a tax bill from that, it's going to increase your taxes on Social Security and Medicare. Okay? Now, in the year 2020, due to the CARES Act, which was a result of the coronavirus, every minimum distribution, all required minimum distributions on all IRAs for everybody in the country, you were given a free pass on that. Now, they even gave you an opportunity, if you'd already taken it before the coronavirus hit, that you could give it back and it wouldn't show up. So, you know, what does that mean? I mean, it means that for those of you that didn't take a required minimum distribution, you feel like you got something or you won something here, but you're just going to make RMDs higher. So when we're talking about distributions from IRAs, these really have planning implications. And what I'd like you to get out of this video is I need a plan for distribution of my IRA. Not the minimum plan, but my own plan that's based upon my own needs, my own tax bill. And so it really affects three areas of retirement income planning, tax planning, and estate planning. Because if you just leave a big balance in your IRA, when you pass away, you know, your spouse or your kids or whoever your beneficiaries are, they're going to pay the taxes on that money. So this brings up the question of Roth IRAs. And the beauty of a Roth IRA is tax-free distributions. You can pull money out of a Roth, you pay no taxes. You also have no RMDs. So another point that I'd like you to get out of this video is you have the opportunity now to move money from a traditional IRA to a Roth IRA. There's a downside to doing this, but the upside is you're going to have a tax-free account that you can make withdrawals from, and it's not going to increase taxes on these two things. So I'm Hans Scheil, and I thank you for listening.